Everyone, we are doing like just those soccer games, football games that you wait for the right time to start. But we are about to reach the time. So I would like to thank Roberto, Paulo Piketty, and all the central bank staff for attending this invitation from XP. XP, as you know, is the largest independent financial securities firm and broker company in Brazil, with a very important presence and exposure in the foreign markets as well. And we've been hosting this event for many years now, and I have many of my colleagues here that are responsible for organizing this event, and we are very proud to keep this growing through time. 1 year ago, we host Roberto as well here in DC, and the times were turbulent at that moment. Maybe they are still turbulent now, but again, it's a pleasure and an honor for us to have you guys here. We are that helped us to put this on. So Roberto, again, thank you very much. Roberto is going to make a initial presentation with slides and so on, and then we're going to have time for some questions. So again, Roberto, thank you very much. The floor is yours.
Hello. Well, thank you, Caio. I wanna say it's an honor to be here. I want to thank XP. Create any kind of noise, and following the recommendation of information for all, I thought it would be better to have it in a format that everybody can see at the same time. Okay. And again, I want to say thanks for everyone today. The idea is to start a presentation and to go a little bit on the global scenario and on the local scenario. Perhaps to talk a little bit about the innovation agenda. I know that in times like this, people don't want to hear too much about innovation. They want to hear about what we're doing. By the way, you mentioned turbulent times, and I remember when I started, I had a conversation with Governor Elam, and he said, everything is very calm right now. So I said, everything is very calm right now, so it's good because I have this innovation agenda that I'm going to implement. And then he told me there is never a calm moment at the central bank, and I think he was right. And when I look back at those years we had the Argentina crisis, then Brumadinho, and then, I think we haven't had like a 3-month period without any kind of crisis. So I guess he was right. So we start talking a little bit about global inflation. A lot of you have followed this very closely. So I will try not to go too deep in some of the slides because most people here follow the data very closely. But we have been telling a story on for concern, And we have tried to highlight that in many different aspects. When you look at headline inflation, again, conversion, but it has stalled a little bit in some of the places lately. But then when you look at the core inflation, it's higher, and this is more true for developed economies than emerging market countries. But then the real focus is we have this phenomenon which is new and hard to explain to some extent, which is we have this disinflation process with full employment in many different places. And it's always hard to tell a story because when you look back in history, it's hard to find, especially in advanced economies, it's hard to find episodes of long periods of disinflation with full employment. And we're seeing that right now. I think it was the central bank of UK that was Andrew that mentioned that lately. Then when you look at services, then the situation is a little bit different. We are having this disinflation in goods, but when you look at services, and again, just look at the last data that you had in US, and even some countries in Europe where you expect things in service to go down, it's still very resilient. Emerging markets is a little bit of a different story because we are at levels of inflation that we have seen in the past. And even when you look at the higher inflation that we had a couple of months ago, was still something that we saw in the past. We have this effect of China, which now everybody's trying to understand. I was amazed on the meetings that I had in New York on how China has become a much more important issue for money managers here in the US in terms of trying to understand, having more concerns, understanding the model and what is the implication of that for commodities and for emerging market countries. And when you look at core inflation again, we are seeing convergence in many places, still at the very elevated levels. And central banks have adopted different strategies in dealing with that. Some central bankers have been more volatile in the pace, going higher and lower. Some central bankers have preferred to give more of a guidance and try to go and to have a movement or a forecast for a movement that controls more the expectations. But then when you look at services, that's where at most of the places, and even recently in China, we see the data is picking up a little bit, and in some places you have stalled, in some places actually going back higher. And again, you have this phenomenon of full employment or close to full employment or going to full employment in many different places. Here on US inflation, I think it's very interesting because I remember, I think it was back in the event that we had in Marrakech. And we were talking internally. And we were debating, basically where the disinflation, the further disinflation is going to come from. And I think we stumbled to a fact that we were not seeing very clearly where the disinflation, the further disinflation would come from in the US. And I've gone through this over and over. If you look at my last presentations, I look at all the usual suspects one by one. So we look at rent, we look at housing in general, we look at the labor force, we look at the disinflation coming from China, which was one excuse that was used very often. We look at the immigration effect that was actually used a lot. And then you look at the cost part of companies and the greening the financial system. That's very costly for companies. You look at surveys that show that. The whole replacing of the supply chain, we also look at that and how much that was adding to costs. We also look at the supply chain and seeing that a lot of the disinflation coming from there was over, and we started to see some pressure again. And you had I guess to some extent, what we're trying to say back then is that we don't know for sure, but there are more uncertainties. I think the uncertainties have proven to be true. And if you look at where we are right now, we are trying to, now with a market that has repriced a lot, what's happening in the US, we're trying to see, okay, we have gone through a repricing, but where we go from here? Does it mean it's higher for longer, higher how much, for longer, how long? and what is the effect on that. And so it's very important to go back to that argument, because I connected that argument to the fiscal many times, and to the fact that eventually, once that happened, and I think it's happening now, people will turn and talk much more about global debt and the fiscal effect that we have. Collectively, the world spent a lot of money on the pandemic, and it's not only that the debt's much higher, but also the cost of rolling the debt's much higher, and that eventually, even though we still have liquidity, a lot of liquidity going around, this eventually will start sucking up the liquidity, and we have a crowding out effect that I think it's something that, you know, I'm not saying it's going to happen, but it's something that we need to watch. I think that could be the next big issue. I think the repricing in the US is happening to some extent already. And then again, we look at core service. Country, which pretty much meant that people were looking at the US and trying to figure out, you know, what can we do once US starts doing it. And there was a big debate on emerging market countries, especially for those who have a very low neutral rate. And the debate was, how low can I go? And then the first question is, can we go lower? Then the question became, and Paulo participated with me in some of the debates. And there was a question, you remember that, is can we go lower than US? So can our emerging market countries have interest rates that are lower than the US? And at that time, I think almost everybody said, yeah, sure. I mean, we have a different reality. We have a structure, a neutral, an R-star, a neutral rate that's low. Now I think this is coming to reality, which is, it's difficult. I mean, we have this liquidity issue, and it's repricing. You see that the repricing in the emerging market was very intense in the last couple of days, and I think it connects to this debate that we are having at the BIS with other central bankers in Latin America, in which is, what is our reality if that happens? And again, we always defended that it was very hard to see the disinflation in the way it was described, and I think now we're trying to see what is the consequences of that. So we go through, I'm sure you've seen this curve many times, and the dots also. I think everybody's by now bored about the dots and trying to map the dots, and whether it's going to be 3, whether the next one is going to go to 2 or not, and then whether it's going to be, now the market seems to be between 1 and 2 cuts, and it's going to be very much data dependent. So I think the volatility in the short term will increase. You can see that in some of the market indicators. And also, because that happens in the US, the volatility globally will become higher. And the problem is, a lot of people have the carry trades on FX, and that is being, I think, unwound too. So that is creating a little bit more volatility on FX. When we look at the global growth, the story changes a little bit. We've had revisions on the upside on growth. You can see here when you look at the difference between the February 2024 and October, and we looked at but still, the message is pretty much the same. The global surprise index, you're seeing the ones that were really disappointed, like UK, picking up a little bit, and the ones that are very higher, in terms of surprises, is stalling a little bit. So it's converging, I would say converging to what people thought would be like 3 or 4 months ago. But with the fact that the labor element of it's much more present and much more intense than people expected. Then when you look at the global activity, I'm not going to go into, I'm sure you've seen this presentation before, but you have all this discussion, what's happening to our star. And I think that was a very intense section that we had with the other central bankers. And looking at the models, and you have the time series models, you have the structural models and the realities. It's been very difficult to have a very oriented debate on that. Even for US, you have a different results whether you use the Labac-Williams or if you use a don't reconcile very much. Then when you go to US economy, the graph that I like the most, and I've been using this graph for a long time now, is the one on the right, because that was the graph that we used in the very beginning to tell you a story that we didn't think was going to be transitory. There was this huge shift in the demand for goods, and it didn't converge back to the trend line. Actually, we elaborated further on durable and no durable, and we look at time. And now you have a situation in which not only the goods are not converging, it has actually in the last couple of data points being a little bit softer. But then when you look at services now, it's much more than compensate for that. So again, it goes back to where the disinflation is going to come from. This is a graph for the US. Europe, you have different formats of the graph. But for the big European countries, it's pretty much the same. Then you have this argument of, consumption eventually will go down in the US because you have the savings, and the savings is being eaten up, and the transfers, the transfer programs are actually diminishing. So you have a bit of a fiscal cliff coming from that. We look at that again in every possible way. Basically, we're seeing when you look at disposable income, you're seeing the trend. Then you look at services, and the kinds of services are very correlated to the consumer spending by age group. And in the US, you have this phenomenon that older people are becoming much more relevant in terms of the consumption basket. That has to do with the fact that the share of wealth held by older people have increased a lot. So again, that goes to the fact that when you look at that, it's very hard to tell that you're seeing a disinflation that is obvious coming from that. You could have a disinflation, but it's not obvious, and I think it's highly uncertain. And then China, which like I said in the beginning, was a bit of a surprise because I didn't expect in the meetings that we had a couple of meetings at the Fed this week with the biggest money managers in the US, and China came up a lot. And being an uncertainty and people trying to understand what the model is. I think the same way there was a huge investment in infrastructure, now there is this huge investment in electrification. We're seeing electric cars, Chinese electric cars everywhere. We're seeing that in Brazil too. And people are questioning, China seems to go in these waves in which when they focus on something, they really become big on that. How efficient is that in terms of allocation of resources? So there was a lot of conversation on that. And also the puzzle of having investment in real estate falling a lot and having the sales fall a lot. We almost no effect in prices is something that it's always puzzling. Part of the conversation focus on that too, on the fact that the savings is very high, but people don't want to buy real estate anymore because they don't feel as safe as they did in the past. So what is being done with the the money that people are saving in China? So that was part of the conversation too. Well, you all know this by heart, so I'll pass. It's just Treasury and S&P again. The S&P, when you look at Russell and S&P, and this has been a trade that's been a winner trade for a long time. And it continues. You continue to have this tendency of innovation, pushing the ability, and here a lot of people have different estimates on what artificial intelligence will do for companies. But the fact that this is mainly being produced using hardware, semiconductors that are made in US is pushing everything higher. Then comes that effect. I'm not a big monetarist myself, but when you look at like M2 and all the measures of liquidity in the US, I mean, you are always left wondering, if rates are so high in the US, how come you have so much liquidity? Look at the money market, you look at the liquidity, and you look at M2, and the fact is, part of the questioning comes from the fact that rates are very high, but when you look at financial conditions, they seem to be very accommodative still, and every market tells you that. So what is happening different from what we expected in terms of the reaction from rates? And I think here we have more questions than answers, but the fact is, US seems to be doing fine with higher rates, and you still have a lot of liquidity to go around. So what is it going to take for that to actually become a soft landing? Oops, sorry. Fiscal policy is something that also I've been kind of like a broken record on that, because I've been trying to focus on that and trying to see if we can anticipate something arising from that since mid last year. I think when you look at the global debt, it's much higher. When you look at the cost of financing, I have said that over and over again. But amazingly enough, if you look at the articles in the paper and main economists, people are focusing more on that right now. You're seeing more and more people saying, you know what, the debt is sustainable. Even the chairman of the Fed has said that in an interview recently, the level of debt in US is unsustainable. But I guess it's more than that. I mean, if 60% of the debt costs 3 times more to roll over, and if you have increased this debt by 25% of GDP during the pandemic years, how come there is no crowding out effect? What's happening when you look at the cost of rolling over? And again, I was with a group of central bankers from Africa the other day, and they were telling me how hard it is to raise bonds now compared to what it was in the past. Because if you have a good credit in US that pays you 7.5%, it's going to be very hard to buy sovereign bonds from a country that you don't know well at 9 or 8.5. I think that tells you where this is coming from. You have the taper story that you've been following that, and I think they will follow on the promise. And then when you look at the biggest tail risks, inflation, high inflation seems to come up again. And again, I think what it's behind that message is, are we going to have higher rates for long? And if that is the case, what does that mean in terms of the reality for markets in general? What kind of repricing do we need to see? And what it means for emerging market countries, which is relevant for us. And I guess there's still a lot of question marks on that. So again, that goes to the fact that we have been saying for a while that uncertainty has increased, and that we need to face that and understand that. Going to Brazil, we are seeing inflation converging. We had the last print that was a good surprise. We don't react to like one data point or like one data, but we were saying that we were worried about some of the components on the inflation. That has improved. We had one data point. We need more time to see how that's going to evolve. We do see that some of the things are going more or less the way we expected, even though we had on the service part a little bit of a decoupling from what we thought was needed to achieve conversion. We did an extensive work trying to see what is labor intensive, what is not, how can we look at core inflations, and how can we core inflation, and how can we look at what is being influenced by labor. What we're trying to get at is, can we tell a story that the more labor intensive segment conversation. I had this conversation with Paulo. It's hard because there are sectors that you start to say, okay, but this is not that meaningful. So we try to look at services in general and try to segregate what is the component of labor in services, even those that are not very labor intensive. And it's a very difficult exercise. We're still working on that. But it seems to be telling us that yes, there is marginally a pressure on those coming from labor. And again, we separate in inertia sensitive, slack sensitive, and labor intensive. We also separated by the growth of the sector or the importance of the sector. Both ways we try to measure and average those out. And then inflation expectations, which is something that is very relevant for us, and make no mistake about, for us, it's very important to keep these inflation expectations anchored. We know we have a difficult job ahead of us, and we will do what's necessary to anchor inflation. That's very important to repeat and repeat again. We saw the break-even inflation, especially for 25, going higher. We understand that you have this new round of uncertainties. I think more recently, part of this is related to this repricing of global conditions. I think a bigger part is a global story. There is also a story that is local and is related to risk premium from many different factors, one of which is the repricing of the fiscal, and we have said that. One of the things that we've been saying is we hear a lot of people look at the real rate in Brazil, but we have tried to say that when you look at a more long-term perspective, then eventually you see that real rates are converging. They have these peaks and then they go back down. But when you look at a more medium term or long term and you average the numbers out, it's converging to a low number. So every new cycle, we are able to fix it with less real rates, and then we are able to converge to a lower rate. And one of the things that we have said is people look too much to real rate, and they forget that what's matter for us, what is important for us is not the real rate, it's the difference between real rate and neutral rate. And then if you compare real rate for different countries, not taking into consideration what is the neutral rate, then it becomes much more difficult to tell a story. And here we are saying when you look at Latin America, we have, in terms of tightness, we have the less tight real rate when you compare to, in terms of monetary effort, which is the difference between real rate and the neutral rate. And we did that for advanced economies too. I've shown this graph a couple of times, but I think it's important to keep that message. The coupon statement I'm going to skip. And then when you look at activity, again, this is a place where the story has been very good. We have been consecutive updates. If you look at the numbers that just came out, and you look at the number, the ABCBR, people now will converge in the first quarter between something between 0.5 and 0.8, and that's the story that I'm seeing. Which it makes it difficult unless you have you see something very different from the second semester. It makes it difficult for growth to be below 2. So we think this revision is still in place. We raised the question of potential output and connected that to the fact that we've been missing. The estimates have been missing reality for a long time, 3 years now, more than 3 years, and trying to understand if there's something that is out there that can explain in terms of the reforms that were done and what that can do to potential output. We were in a meeting the other day and someone asked whether peaks, remember whether peaks would add to that, would add to productivity. It's a very interesting question we haven't measured, but I'm sure looking at the numbers and the new business and the fact that you include a lot of people into you bunkerize a lot of people, I think it has an effect. We just need to understand how that plays out. And in terms of economic activity, again, retail very strong. We have this mixed data sometimes between retail. We look at services, and we had a soft data. Again, we don't look at one data point. It's important to see the tendencies. I guess that means I have to go home. or I talk too much. Huh?
Let's call the fireman, please, to help us to put out this At least wait until happy hour time.
Yeah, I think it's happy hour time now. Okay. Huh?
It's
no?
an event. It's an event in
Oh,
the
it's a neighborhood. Okay.
It's an event in the neighborhood. Probably.
So we have an event.
School of Samba.
We have a more interesting
meeting.
event next to us, so perhaps we should leave and go to the next room. No, okay. So again, we're looking at soft data and hard data and trying to understand the dynamics. Again, we go back to the argument that we're seeing these revisions upwards, where labor is very strong. So we need to see how sustainable that is, and it's important to understand that. Also, the various ways of looking at the labor market. I'm sure you do this exercise just as much as we do. The fact that you have this this participation effect that we thought for a while would be something that we needed to watch. It's now being normalized. The fact that when you look at real earnings is going higher. Every measure now that you can do, whether it's informal or formal jobs, are pointing to the same side. But again, we haven't seen that affecting what we think is a provision for the forecast for inflation in services. We are seeing, like I said, when you look and we try to segregate, we see a little bit of an effect, but it's too early to say that we have a tendency, and that is something that we need to address over time and to have more data points to analyze. The fiscal numbers, I think here is where the story has changed recently. We had the fiscal revision. It is true that the fiscal revision was in direction to something that the market was to some extent expecting. I think when you do that, actually what happens is the premium moves further. I hope it doesn't, it's not the case now. But the problem is,
the president of Mozambique has just arrived. That's what they told us, and they are celebrating his presence here.
Oh, really?
Yeah, no, it's true. It's true. It's true.
Okay, so eventually he's going to talk, and they will lower the music.
Just to.
And so here on the fiscal, I think the problem is, and we have mentioned that the fiscal target, the fiscal anchor, and the monetary anchor are very closely related. And so if you lose credibility, or if you are going into more questioning regarding the fiscal anchor, then it becomes more expensive on the other side. And that's what I said last week, and I think it's important to understand those things are related, and the Minister of Finance have said many times those things are related. We always defended the fact that they should stick to the target and do whatever is necessary to achieve it. We understand there was a need to change. The idea is not to comment so much on the fiscal, but to try to see how that is going to influence our reaction functions through the various measures that are important for us. So I guess it's enough. I'm going to go really fast on the technology because I know you want to know more about. But just saying that, when you look at the 4 blocks that I think make the bulk of our innovation project, we have advanced on PIX a lot. We have new features. We have the automatic payment that is going to come in place. We're looking at ways of doing back blockage on PIX, which means that you can mimic what a credit card does today, just using PIX. So it's going to be great for banks and for people to be able to do like credit card functions inside the rail of the PIX. The internationalization, we are advancing, and it's part of our work on the G20 to trying to find a taxonomy for cross-border payments. Here we have advanced on the technology part, but we haven't advanced on the governance part. And it's important because different countries have different governance aspects. On the open finance, that has, really, really taken off. We have a lot of data that I could mention to you. More than 1 billion reais in credit have been done already to the platform. The lower cost of opening an account, the lower timing for opening an account, people migrating products from one bank to the other. So this is happening already. This is going to intensify exponentially as we move into these marketplaces environment that we think will exist very soon. And then the DREX, the tokenization of the economy, and our digital currency, which is now running a pilot. We are still trying to surpasses a problem that nobody has solved, which is how to have scalability and privacy in a platform that is wide open. So in other words, you're using full DLT as opposed to what we have now in some of the digital currencies, that they use centralized system inside the central bank, and then they use the DLT just as messaging or as a channel to show the final transaction. Then we have the two additional blocks, artificial intelligence and data monetization. We are working on data monetization with some companies, and we have, I think, some progress to show in the future. And we are questioning ourselves, how can we use artificial intelligence to improve the user experience inside what we think will be this environment for finance, these marketplaces. Some of the graphs on PIX, I think I would here highlight the fact that as we launch PIX, the bancarization increased a lot. These are now the new functionalities. Again, you can see that in our website. The internationalization, again, I went through the fact that we have solved some of the technology and the settlement issues. We need to work on the governance. The benefits of DREX, I think I have said many times that we think this project actually will take us to a level of tokenization of the economy that will make everything much more efficient because of banks, because of contracts, and because of the programmability of the money. This is a bit our schedule for DREX. Again, we are facing a problem right now, which is trying to be in the frontier of developing that, and knowing that nobody has solved this problem. The Central Bank of Korea is also doing the same thing that we are doing. A lot of people have converted their programs from doing a digital currency that was inside the balance sheet of the central bank to doing a digital currency that is a tokenization of deposit format. So I think Brazil was I think was the first one to create this way of thinking about digital currency, and I see that other central banks now have followed. This is what a marketplace would look like, or what we call the super app, and so on and so forth. So I will end here, and just to make sure that with the sound of the music, I get the messages right. It's important to stick to that. So the first thing is the external has no mechanical relation. We have incorporated in our reaction function the various mechanisms, and we look at what's happening. We did have a repricing, a big repricing recently, and we need to see how that's going to impact our reaction function. The external scenario is much more diverse. We have much more debate about the way in which disinflation will take place, which could mean interest rates higher for longer. And I think that will bring the debate of the size of the global debt, the fiscal part of the equation. And I think this will actually force countries to do a better homework on the fiscal. And again, this is not new. I've been saying that for a while. When you look at domestically, the activity, we have some positive surprises, a lot of resilience on the job market. In inflation, like we said, we're not going to react to a data point. We're looking at a trend. We had seen a worsening trend in services, and we have expressed concern on that. We had a good data point recently, even though we're still looking at what that means. On the fiscal part, from a long time, we said that it was very important to persevere with the goals. Again, there is no mechanical relationship. It's not mechanically linked. But the evidence that we get from what happened in the last couple of days tells us that the market has become more worried about the fiscal, and that might change the expectations for what the fiscal equilibrium will be in the future, and that will have an effect in the risk premium, and that also makes the job in terms of the monetary on the monetary policy part makes the job more difficult and more costly. The reaction from the market implies that part of the recent revision comes from the fiscal, but a bigger part, I would say a much bigger part comes from the external. So I think it shows that there might be some questioning to the credibility in general, but for us, again, it's not mechanical. We need to know what is important in terms of our reaction function. the central bank has a clear mandate to do whatever is needed to anchor expectations and fulfill the target, and we will do whatever is necessary. When you look at the connection between what we have said lately, I think it's very important, and perhaps this is the most important thing that I wanted to say today, is that trying to understand the connection and the logic between the things that we have been done. So first we had a longer guidance, and we had greater visibility. Then we switched from a longer guidance and we took out the guidance, and I understand there was a lot of questioning on that, because we thought the uncertainty was higher, both locally and externally. And I think it's proving recently that actually the uncertainty on the external scenario has actually increased. So we moved from guidance to getting out of the guidance. And then eventually the question is, what do we go from here? Well, we could have a reduction in the uncertainty, which means we take the usual path. We could have a system in which the uncertainty becomes and continues to be very high, but it doesn't change significantly, which might mean a reduction in pace. We could have a scenario in which the uncertainty starts to affect more strongly important variables, and then we need to go and talk about changing the balance of risks. And we could have a scenario in which the uncertainty actually aggravates, creating stress globally, and in that case we would change our base scenario. So I wanted to make very clear that those are more or less when we concatenate ideas the way we think we should proceed from here. Thank you.
Thank you, Roberto. Very, very interesting and clear presentation. Even with the music, you could surpass the interest of the audience from the music. Gonna have some questions from the audience, from our clients, but I'd like to kick off here, taking naturally your last point. So you made a graduation of uncertainty, and obviously monetary policy would react depending on, or monetary policy guidance would react on the degree of uncertainty. Would you say that what happened recently in the markets, we had bad numbers for the central bank of the U.S. last week, and a reaction from the governor. We had mixed data from Brazil, some stronger data, some weaker data on the economic activity. Inflation was good at that data point, not that good before, and fiscal, as you pointed out, is less clear what's going to be the stance of fiscal policy going forward. So in that sense, would you say that uncertainty has increased since the last Copom meeting, or you're still trying to so the dust is not settled yet? How would you see that?
I would say that we were expecting uncertainty on the external part, and actually we were being criticized, and like I said, some people said we were seeing ghosts. So I think in that sense what has happened is in line what we were saying. Obviously you can never tell what the repricing will be and what is the reaction, what's the impact on the variables that are part of your framework. So we need to see. I mean, I think it's too early. We had a bad day today. Last time I looked at it was a little bit better. So I think we need time to see how the world is going to digest the fact that we might have higher for long in the US. Also, there is at the same time we are digesting the fact that we had a revision in the fiscal numbers, and we don't know to what extent that will create a dent in the credibility. We don't know that yet. We need to observe. And again, for us, what's important and what that means for the variables that are relevant for our framework, and it's too soon to tell. So I would say that we have more uncertainties than the last Copom meeting, but I would say that part of these uncertainties we actually thought, we actually saw it, or at least we had anticipated that might come, but we still need time to see what is the impact of those uncertainties on the variables that are relevant to us.
Thank you.
Can I add up to that, Roberto, before our clients start? Victor here. Eventually, you have to provide an estimate in the next coupon meeting. You have to run the models with the new, the recent information from the focus survey and whatever the BRL is going to be in the 10 days before the meeting, and you have to like produce a number for 2025, which everybody's looking at. Do you think that, I understand that you said that uncertainty has increased, but we need more time, but you have to provide a number eventually in the next coupon meeting. Do you think that this number might not, even if it's higher, but you're still assessing the uncertainty until there, is it enough for you to change, to make a decision in this meeting, in the next meeting, regarding the kind of the level of uncertainty change that you had between meetings? Or maybe you think that, hey, even if this inflation is a bit higher, we're in a volatile environment, we need maybe we need more time and make a decision in the next meeting. How do you think this is going to go?
Well, even of all the music, I cannot tell you what we're going to do in the next coupon meeting. But what we try to do is a gradation. We try to segment and concatenate the ideas and try to have a different level in terms of the grades in which we would work. And I think that's what was my last argument. So between guidance, getting out of the guidance, and then going to whether you have reduction in uncertainty, the same uncertainty, and then you need to see what's the impact of that, or increase uncertainty. I think that's the most I can say in terms of what is going to be the issue for the next coupon meeting. From here to there, we need to observe day by day. Yes, like I said, yesterday was a day that people were saying the repricing is going to be much more intensive. Today is a better day. We need to understand that if we go back long enough, and if I was told that the US rates would be at where they are right now, I would probably tell you that the market would be in a complete disarray. And that didn't happen. So for some reason, rates are higher. Now rates seems to be higher for long, and the market somewhat adapting to it. What I think will be the next issue is people will be talking about the sustainability of that, because once you go from an experience of having a transitory inflation that's not so transitory, all of a sudden it's more permanent, and all of a sudden you have higher rates for long, it's so natural that the next step is people will talk about, okay, what is the meaning of that for the debt, for the rolling over, for the crowding out effect, and for emerging market countries. But I cannot give you any more specific answer to that, because we are in the process of learning how the market is going to react to that.
Good morning, Governor. Fernando Genta here from XP, or XP. My question is related to the first two. Looking at the focus, it's moving towards to 3.6 next year. Activity is stronger than expected again. Fiscal is being repriced, and we have all this new environment, international environment. It seems that the balance of risks is not as symmetrical as we thought recently. That said, we have two risks now, on my view. First, a credibility risk due to the inflation expectation, the anchoring, but on the other hand, we still have a forward guidance, narrow forward guidance, but we have a forward guidance for the next meeting. Thinking about central bank credibility, do you believe that it might be on risk if you change this guidance on the next meeting or not?
It's a good question. Every guidance has a disclaimer, and the disclaimer means if the situation changes substantially, we might evaluate. I cannot tell you more than that. It's written in the message, so I'm not saying anything new. We need to access the data. We still have a couple of days between now and the next coupon meeting, and we are right now in the process of actually seeing the sedimentation or the realization in terms of prices of two things that happen. And I think the most important one is on the external part, and to what extent the markets will react, and that will influence what is important for us. So I would tell you that every time we have a guidance and you need to change, it's an issue of credibility, but every guidance, because you don't know the future for certain, comes with a disclaimer. So I cannot tell you more than that. We need to wait and see for the next meeting, and see how the variables evolve from here to the next meeting. What I can tell you is that we are not afraid to do what's needed to do. And I think we have tried to show that to the market, and if needed, we will show again and again.
Hi, Roberto. Thank you for the presentation. We saw this kind of volatility last year during October, and the central bank, I believe that he had a very calm reaction over the markets. Part of that because of the foreign guidance on the 2 next meetings. Part of that because we were in the beginning of the cycle. How to manage that in this case? We are in the middle of a sell-off in rates and in the FX rate right now. I know that it's not a good time to make any medium-term decision. And now we don't have the two meetings for guidance. We have just one. You said that there are 2 or 3 possible ways that we can go, but how to manage the decision on the next couple of meetings in the middle of a sell-off and the BRL depreciating so much and the fiscal news. Any thoughts on that?
I think it's always a balancing act, because you don't want to react too much to short-term data. At the same time, you don't want to ignore too much a structural change to the extent that you lose the credibility. So I would probably say those are the 2 things that we look at every time we take a decision. We have a movement in the short term. We don't react to short-term data, but what is behind this movement? Is it a structural change that we need to pay attention? I think it's too early to tell, but this is the way we think at every time on whether to reassess the scenario or not.
Hi, Governor. Thanks a lot for your time. I'm wondering what kind of one-offs are you seeing in economic growth that is impacting your view not to overreact to the latest strength in retail sales? And more specifically, we had the news on precatorios at the end of the year, which was a significant amount of money disbursed, potentially affecting consumption. Is this something that you're looking into that might be a one-off and this strength is kind of temporary, or what's kind of holding back the idea that growth is not that strong?
Okay, if I understood your question, is related to growth, not inflation. So you're saying, what if you have the effect of all this stimulus together and that's creating higher growth, and then we are facing a fiscal cliff and that will bring growth lower? If I understood right, your question was more or less framed like that. And I guess when we look at the different components of growth and it's more wide than expected, you could always try to quantitatively assess what was the impact of precatórios. We look at the fact that a lot of the withdrawings from precatório were not persons, were companies, which means that someone already had cashed their precatório before, and so using that information can try to simulate what is the amount of this that is actually going straight to consumption. We also look at payment of debt on an individual basis to see whether the money was being used to pay debt or not. So there are many things we have looked at. But again, we are coming on a 3-year period, more than 3 years, that have missed growth. So you can always make the argument next month is going to be different from the last 3.5 years. But the reality is you need to look inside the data, and inside the data is telling us that it's more wide than we thought. It could be that it's more wide because the transfers have trickled down in a way that is actually signaling something that is difficult for us to see. But right now it's hard to make the case that is just a blip. And if you look at the history of the data, it tells you that it's becoming more wider when you look at the growth, okay? More widely spread.
Well, Daniel Weeks. Roberto, first I want to congratulate you. You're the best Fed watcher that we're seeing right now, so you're getting it right. But when you you're always making the same question about where's...
And the best central bank in the world, according to those awards that he received.
So when you always ask the question about where's the next step for disinflation, looking at the US, so here, and if you compare Brazil to the US, so there, both countries have fiscal issues, but ours is getting worse. Both countries have, issues about what is happening in the labor market. Here is loosening, in Brazil it's getting tighter, activity is reaccelerating, and our expectations are unanchored compared to the US, they're anchored. So don't you think you should ask, how will we get to the target? Because it feels to me that our situation is worse than the US. Thank you.
So the idea was not to compare our situation to the US, and being a Fed watcher, I think comes from the 20 years being on your side of the table. But the question is, the dynamics are very different, and I think the way this gets into prices, to the different prices, is very different too. In US, you can clearly see the driver of growth being something that you can connect to innovation. Whether that's producing productivity or not, nobody knows now. And even when I talk to people at the central bank in the US, they have different opinions. In the case of Brazil, it's different. I mean, we had growth, we had stimulus. If you think about stimulus over GDP, I'm not so sure that US is that much higher. And also, if you separate what goes into consumption and what goes into investment, also you have a different picture. And I don't have the numbers by heart here, but I've looked into that in the past. But the idea is not to compare. Brazil has an inflationary memory that's very vivid, and that makes it more difficult to anchor. US is coming from a period that the hardest thing was to actually get inflation to go higher. And actually they changed the framework in a way so to gain more degrees of freedom to wait for the inflation to go higher. That's very different from us. So I don't try to make the connection. For us, the only important thing is whatever happens in the US has an effect on the variables that we look, and they're part of the framework. So I need to have a scenario and looking at the risks or the uncertainty around the base case to see what kind of reaction I might need to have if the base scenario doesn't materialize. And that's what we try to do, and we have tried to explain, and that's when we try to segment and have these different grades of actions that I might take. That's, I think, what we're trying to explain to you. What we try to explain to you.
Thank you.
Thanks, Governor, again. Question. When you're being asked about what's happening to BRL over the last few years, the last few days, I'm sorry, the big depreciation, you say something like part of the story is the repricing, the global repricing and the Fed, and other part is the fiscal, the Brazilian fiscal issue, the domestic issue that finally people start to pay attention to it. And then I wonder what of the two options is happening. One option is finally BRL is depreciating, and you can send a message to the politicians that only look at the BRL and say, guys, the fiscal is an issue, pay attention, you're sending a message. Other option is you're really thinking the BRL is reacting to the fiscal issues, and then people are finally paying attention to the fiscal. And if people are, the sky is the limit, because anyone who can do basic calculations can see that debt is totally unsustainable in Brazil, and then you have a much higher risk neutral rate in Brazil, and then you have a big issue here in front of you. So which one of the two you're talking when you're saying the story?
No, I don't want people to put words on my mouth. I didn't say I think anything. I just said when I look at the readings from the market, and again, you are market agents. You make the price, right? So when I see a price that is changing, and I read the comments and analyze what's happened, the feeling that we get is part of the change, part of the movement, and the large part was done by external. But there was a smaller part that was attributed by you who moved the market to the fiscal. So it's not that we are saying that the fiscal is responsible for that. We are saying that by reading the market, which is part of the job that we do, we have the feeling that part of the deterioration in excess of what happens in some other places has at least partially the explanation. And you have other noises like Petrobras and Vale and so on and so forth, but part of that is related to the perception that the revision of the fiscal makes the sustainability of the debt a more difficult thing to achieve. So I just want to make that sure. And then whether that is a message and how we use the message, we don't intend to use that message. We think that the effects is floating, and that's very important because it's a shock absorber that has a very important function in terms of allocating resources and telling us where the demand for hedge is and why. And again, I go back to what I said before. The important thing for us is how these variables influence our framework and whether we think this is temporary or there is a more structural change that we need to pay attention.
Just to add Fabio's question, considering especially recent price action, are you guys discussing the possibility or the need to step up interventions from the central bank in the FX market?
The intervention is a function of whether we think there is an episode of liquidity or dysfunction in the market, or sometimes there is a gap due to something that comes out that we think was misinterpreted or misread. But we don't react to the fact that people are repricing our risk premium. And reacting to that is very dangerous because there are many different ways in which you can hedge risk premium in Brazil. And the fact is, if you suppress too much one of those, there is a leakage to the next one. So if the government was to intervene too heavy on FX, what you'd see is the long end of rates would blow up because people look for a different way to do hedges. And so there is always that question, what is the optimal amount of intervention when you see that something is not reflecting reality? Well, you don't want to intervene too little so that it creates a speculative movement which is nonlinear, but you also don't want to intervene too much so as to block the information that you would have from that asset and create a linkage to another asset in which you have much more difficulty trying to intervene, for example, the long end of rates. So the idea is we think the market, the FX is floating. We think it's an important function that it has, and our intervention is only for the circumstances that I just mentioned, which is market malfunctioning, a gap in liquidity, misreading or misinterpretation of something that, at the time perhaps you can and you will be able to clear, but is not related to fight perception of risk premium when we think there was a fundamental that has changed.
Thank you, Roberto. I think that Junior has a final question for you, and then we'll be closing.
Thank you. Thank you, Roberto, for being here with us today. Also, Professor Piquet. I'm Júnia Gama from the political analysis team at XP also. As you mentioned, we had in previous Copom meetings the message that the government should keep working to reach the targets that were already established. Since we had a change in that target for next year that was announced this week, I was wondering if you think that there's anything the government can do in order to minimize the risk of contaminating that decision, contaminating the monetary policy.
I think it's probably not up to the central bank to give policy recommendation on the fiscal. I would probably say in general, the more transparent you are when you have to change something, the less damage you do to credibility.
Very good. Thank you, Roberto. I would like again to thank all our institutional clients that attended to the meeting, to our events here in the IMF meetings. I'd like also to thank all the XP clients that are watching us through XP YouTube, and finally congratulate Professor Paulo Piketty, Roberto Campos, Governor, also the former deputy governors that are here with us. Fernanda Guardado just wrote me here saying hello for you guys.
It's very good to see you all here.
Yeah, and to congratulate all the job that you've been doing, a very technical job that are helping definitely to put Brazil in the pace of growth and stability. So again, thank you very much for the presence, and we'll continue our event with other panels. Thank you very much.
Thank you so much.